Another earnings alert here on Lululemon. Shares are sinking after the company beat EPS but missed revenue estimates. Same-store sales and full-year guidance also coming in below expectations. Here with his take on the quarter, Jefferies Managing Director Randy Konik. He's got an underperformed rating, a $150 price target on the street, a street low, in fact, per FactSet. Randy, great to have you with us. You've gotten the story right for so long now, and I'm wondering, another disappointment here. What do you need to hear from this company? What do you want from this company at this point?
I think what we need is we need a confession. We need a confession on the earnings guidance. They took the numbers down. We thought they would. They just didn't take the guidance down low enough. And the way this works is when a brand is soft or has no momentum in the spring season, it's pretty awful in the back to school and holiday season. So while the numbers were cut, they weren't cut enough. And I think what the company's trying to do is get the market focused on next year. And what they're going to have wrong is they think they're going to grow next year. We think they're going to have declining growth because of the competition. So we have numbers well below the street. And until the company confesses to their sins of earnings power much below where it is today, that's when the stock will bottom. Until then, it won't.
What is its biggest problem at this point, Randy? I mean, is it the competition? We were just remarking here on the set, we see Vuori and we see Aloe everywhere we go. Is it lack of execution? Is it what is the number? If we change management team, for instance, would you get a better result?
Look, I think we do need to change the management team. That's number one. Number two, it's also a product of its own success, or an issue from its own success. What we've been talking about in our research is you look at the metrics here. The metrics have been amazing, honestly, over the last few years until the last couple years. And what we had started to see about 2 years ago, and we've been bare on this for 2 years, is that we saw a peak in the fundamentals both on sales per foot and for margins. This company does $1,550 per foot in sales. That is 4 times the mall average. They do over 20% operating margins. That's well above peers. That's great until it's not. And that's where the issue lies today. And because those metrics were so good for so long, now they're starting to come down. They can actually crash. And until the numbers get crashed and the company guides to those crashed expectations, the stock will just keep falling and falling further from here.
Randy, it's Tim. Congrats on this call. It's been great, and therefore I
appreciate it.
All my faith is on you at the next tractor pull down wherever you are. So you talk about crash, and also their capex as a percentage of sales is highest in the sector. I saw one of your competitors had a note that talked about that too. I mean, at what point are they going to try so hard? It's not just the numbers. It's truly that they run themselves off the proverbial cliff. Obviously, this brand is popular. It is out there. But are they trying too hard to reverse field and maintain where they were?
Look, I think the brand is relevant. I wouldn't say popular because their July sales were their worst of the quarter, yet the industry had its best sales trends, the industry in the July period, which means that these guys are losing massive market share. As it pertains to your CapEx comment, I think it's a very good one because this company is still growing. What do they use CapEx for? To build new stores. And they're opening stores at a double-digit clip on a square footage basis. You know what that does? It adds fixed cost expense to the business model, which means as sales decline, you get rent deleverage, which means margins compress. So that's really the big problem here, the death spiral of margins and earnings going down further because of these high fixed costs that were incurred and still incurred as the company had a great brand for the last 5 years. That's going to be, I think, the one thing they need to do is shut the store growth. You can't do that right away. You're going to have to do that, I think, in 2026 because you're locked in right now for the rest of the year. Shut the stores, get back to basics, get back to being who Lululemon was. It was an athletic business. And now they've tried to change into the Gap. And I think that's the key issue with this company.
Randy, it's Karen. Excellent call. As we all said, I mean, that is excellent foresight for a long time. So speaking of the Gap, we saw Athleta. That was a really weak quarter for them. This is obviously a very weak, not this past quarter, but the guidance here for Lulu. Are we finally at this point where maybe the whole athletic thing is starting to get long in the tooth? Or not? You talk about, there was some bright spots during the quarter. Where do you think the whole zeitgeist of athleisure is?
I think it's another great kind of topic to go over. Think about it this way, very simplistically. Before COVID, athletic apparel was growing at a high single-digit rate, which was above normalized apparel growth as a general category at about 3%. during COVID, athletic apparel or athleisure grew at a double-digit pace, well outperforming general apparel. That great growth is now more of a hangover as we're digesting all those spending acceleration through COVID. And now we have that hangover for athleisure and athletic apparel. What's also happening is we're seeing some fashion shifts in the marketplace. Denim's becoming a bigger trend. And also, I call it just regular clothes. Like, people are not looking like they're going to the gym 24 hours a day. That's a big problem for someone like Lulu that's depended on that athletic look, for years to drive their growth.